Silver's price action is loud, but the real story is that the physical market is screaming even louder. And by the end of this, you'll have the exact levels and a 2-scenario plan for the next 7 days. Because there is a force right now that wants you to treat this move like a meme candle, a 1-week wonder, something you chase and then regret. And that force is the same old comfort blanket of, it's just speculative froth. But the mechanism that actually moves silver in moments like this isn't emotion. It's math. It's flow. It's sourcing. And if you understand that, you stop reacting like prey and start managing like a professional. Here's the reality check. January has been a vertical month for silver in dollar terms. The kind of month where the chart doesn't look like price discovery. It looks like the market changed its mind about what silver is worth. It's gone from the low 70s at the start of the month to north of 100, and it is printed in the mid-teens, above $110 in the most recent stretch. That's not a normal drift. That's a repricing. And repricings don't move politely. They whip. They fake you out, they punish leverage, they make smart people do dumb things at exactly the wrong time. And that's why the plan matters more than the opinion this week. But that's not the part that matters. What matters is why a move this violent can keep feeding itself, even when the crowd swears it has to cool off. Or because the driver isn't just retail excitement, the driver is the plumbing, where the marginal ounce is coming from, how quickly it can be moved, and how much it costs to borrow, hedge, refine, and deliver it. That's where the real pressure starts. This week is different for one simple reason. The calendar is the catalyst. We're sitting right on a month-end window where funds rebalance, risk managers tighten leashes, and liquidity can thin out at exactly the moment everyone's trying to do the same thing. Month-end doesn't create the trend, it amplifies it. It makes the tape more emotional, it makes gaps more likely, it makes perfect entries a fairy tale. And if we're also in a stretch where headlines are hitting rates and geopolitics, precious metals become the instant reaction trade, until they become the forced unwind trade. So you need a plan that survives both. Because if this one level breaks, the math changes. Now let's get the hidden detail on the table, because it reframes everything. Silver can rally even while Wall Street sells, if the bottleneck is physical sourcing instead of paper enthusiasm. People love to stare at the spot price like it's the whole market. It isn't. Silver is a stack of markets wearing one price tag. There's the headline, futures and spot quotes. Then there's the real world price paid for bars, for fabricated product, for immediate delivery in specific regions, in specific sizes. When those two worlds diverge, the divergence is the signal. And right now, the signal people keep missing is the premium and the pull coming from Asia, especially China, where local pricing has reportedly been running above the global benchmark by a meaningful margin at times. You'll hear different numbers depending on the feed, and some reports get exaggerated in fast markets. So don't marry a specific dollar figure, marry the direction and the incentive. If Shanghai is paying above London or New York for real metal, that creates a vacuum. It creates a pay me to ship it arbitrage. And when arbitrage exists, the market doesn't debate it. The market acts on it. But here's the catch. Silver isn't a tweet. It's a supply chain. It doesn't teleport. It has to be sourced, refined, assayed, shipped, insured, financed, and delivered in the right form. That introduces time. And when time is the constraint, price can move faster than supply can respond. The next detail is what flips the whole setup. Let's translate paper versus physical without the drama. Futures markets are incredible for price discovery, hedging, and liquidity. They're also capable of producing a price that represents financial convenience more than immediate physical reality, especially when the market is stressed. If you're short futures, you can roll, you can offset, you can hedge with options, you can be short without ever touching a bar. But if you're short physical obligations, if you sold metal you need to deliver or you promised product to an industrial buyer, you can't roll your way out of the periodic table. You need the ounces. That's why borrowing costs and near-term spreads matter so much. When borrowing metal gets expensive, or when the nearest delivery month tightens relative to later months, that's the market whispering, "Bring it now." And that whisper turns into a scream in a hurry, because the second the curve tightens, it forces behavior. It forces shorts to reduce exposure. It forces merchants to pay up for inventory. It forces hedgers to rethink. It forces refiners to prioritize. It forces everyone to stop thinking in headlines and start thinking in constraints. And that's where the real pressure starts. The term structure is the grown-up signal. In normal conditions, commodities often trade in a shape where nearby delivery can be cheaper than later delivery, or vice versa, depending on financing costs, storage, convenience yield, and scarcity. When silver is easy to source, the curve tends to feel like a market that can breathe. When it gets tight, the curve starts to behave like a market that can't wait. Even if you don't have the exact spread quotes in front of you, you can watch the symptoms: sudden urgency in the front month, more violent reactions around delivery windows, and an increasing focus on what's actually deliverable versus what's just sitting somewhere. And here's the so what that matters this week. Tight front-end structure makes pullbacks sharper, but also makes dips more likely to be bought by players who aren't chasing a chart. They're managing supply risk. That's why you can get this maddening pattern where silver dumps hard in an hour, everyone declares it over, and then it rips back like nothing happened. It's not because the market is irrational. It's because two different markets are colliding. Leveraged financial positioning on one side and non-negotiable physical demand on the other. But that's not the part that matters. The part that matters is the global arbitrage spine, because it can keep the machine running even if US investors get spooked. Here's how it works. If region A is paying meaningfully more than region B for metal, traders try to buy in B and sell in A. They lock profit. They move product. This is the invisible hand everyone loves to cite. Except in silver, the invisible hand wears steel-toed boots and moves slowly through customs. Arbitrage doesn't instantly close. It pulls. It drains. It creates stress where the supply is. And it can also create sudden relief. If shipments land, premiums compress, and the panic bid cools. That's why your plan has to be scenario-based, not prophecy-based. Now, the mainstream narrative you'll hear is that institutions aren't really in it, especially if you look at ETF flows and you don't see a clean, steady ramp. That's a trap. ETFs are a slow signal in a fast tape. They're important, but they don't have to lead. In stress markets, price can move first because the marginal price setter is not the long-term allocator. It's the short-term risk manager. A dealer who's short gamma doesn't care what your macro thesis is. A short who's bleeding doesn't care about your 5-year supply deficit chart. They care about this week's margin, this week's borrow cost, this week's delivery risk, this week's volatility. And that's why silver can feel like it's possessed. It isn't possessed, it's reflexive. Options and positioning can create these feedback loops where a move forces hedging. Hedging moves price, price forces more hedging, and then at some point the whole thing snaps back because liquidity thins and someone hits the eject button. That's not a conspiracy. That's market structure. But that's not the part that matters. The part that matters is how you, holding silver today, avoid becoming liquidity for someone else's survival trade. So let's talk positioning and margin in human terms. In a fast silver market, sell-offs are often margin events masquerading as new information. When volatility rises, brokers raise requirements, risk teams reduce limits, and levered players have to cut exposure. They sell what they can, not what they want. That's why you get waterfall candles that look like the thesis died. And then, hours later, the thesis looks fine again. If you're not prepared for that, you'll keep doing the same emotionally expensive thing. You'll buy after the rip because you feel left behind. Then you'll sell after the dump because you feel stupid. Then you'll watch it recover and you'll re-enter higher. That cycle is how good ideas turn into bad outcomes. So the psychology shield is not motivational fluff. It's risk management. It's saying, I expect violence. I plan for it. I don't interpret every wick as a new religion. Because if this one level breaks, the math changes. Now let's anchor the other catalyst people forget. Delivery windows. Delivery is when futures stop being theory. Most participants never take delivery, but the possibility of delivery is what keeps the contract honest. When delivery periods approach, the conversation shifts from price to availability. Who's stopping deliveries? Who's issuing? How does registered inventory compare to eligible inventory? And here's the key concept you must own this week. Not all inventory is equal. Eligible can meet standards, but may not be committed to delivery. Registered is the pool that is actually ready to satisfy delivery against futures. In tight conditions, it's possible to have a big headline number for total ounces sitting in approved warehouses and still have tension in the deliverable slice. That's how you get the bizarre situation where people say there's plenty of silver, and yet the market behaves like it's short breath. It's not about total atoms of silver on Earth. It's about what can be mobilized quickly, in the right form, at the right price, without blowing up someone's book. And that's where the real pressure starts. Now, I'm going to give you an action plan, but first we have to do one uncomfortable thing. Admit what we don't control. You do not control the next headline. You do not control an overnight gap. You do not control whether a big fund decides to reduce exposure for reasons totally unrelated to silver. You do control your horizon, your position sizing, your product choice, and your decision rules. That's how you win weeks like this, not by predicting every tick, but by not getting emotionally hijacked by every tick. So here's action plan. Step 1, define your time horizon before the market defines it for you. Are you holding physical as a long-term store of value? Are you holding a core position in a fund or a miner for a multi-month thesis? Or are you trading this move for a tactical swing? Those are 3 different games. They require 3 different risk rules. If you treat a core holding like a day trade, you'll overreact and churn. If you treat a day trade like a core holding, you'll get trapped in a drawdown you never signed up for. Decide the game, then play it. But that's not the part that matters. The part that matters is that once you decide the game, you can finally pick the levels that matter this week. In a repricing tape, you don't need 20 levels. You need a few that concentrate liquidity and decision-making. Think in zones, not single pennies. The first zone is the prior breakout and acceptance area, roughly the low 100s, where silver first proved it could hold above triple digits. If price revisits that region and stabilizes, that's the controlled pullback and retest scenario taking shape. It doesn't mean it can't dip under it intraday. It means it can't live under it. The second zone is the mid-110s, where the market has recently printed, where it's emotionally loud, where a lot of people anchor their decisions because it feels high. Whoa. If silver is holding above that zone into the end of the week's supply chain, traders will be forced to respect it, and dips can turn into springboards. The third zone is the psychological round number above, around $120. Round numbers are not magic, but they are magnets because option strikes, stop clusters, and human attention gather there. If silver starts pressing that area with momentum, you should assume gap risk increases, not decreases, because momentum into a round number often invites the two worst behaviors. Shorts get stubborn because it can't go higher, and longs get reckless because it's finally happening. Both are fuel for volatility. So here's the two scenario lens that keeps you sane. Scenario one is controlled pullback and retest. Price dips, maybe sharply, but it finds buyers in that prior breakout region. The curve stays relatively tight. The physical premium talk stays alive even if it cools. And the market shows you it can absorb selling without collapsing. In that scenario, the trade is not panic. The trade is patience and confirmation. You let the market show stabilization. Multiple holds, a reclaim after a dip, reduced downside, follow through. And then you respect the next upside levels. Scenario 2 is continuation squeeze with gap risk. Price refuses to give you the clean retest. It consolidates shallow, then rips. In that scenario, the danger is not missing the move. The danger is getting lured into chasing size at the worst possible moment, right before an inevitable air pocket. Because squeezes don't end with a gentle fade. They end with exhaustion and then a violent snapback that feels like betrayal. That's why, in squeeze scenarios, your risk tool is not bravado. It's scaling, exposure discipline, and having a rule for what you do if the market gives you a shock candle against your position. That's how you keep your head. But that's not the part that matters. The part that matters is what confirms which scenario you're in over the next week or two. Watch the behavior of the front-end structure. Does near-term tightness persist, or does it relax? Watch for persistent reports of regional premium and sourcing stress, not as gossip, but as an incentive map. Watch volatility itself. If implied volatility keeps rising with price, that often signals dealers are paying up to hedge risk, which can amplify moves. Watch for the reaction to bad news. In strong trends, silver shrugs off bearish headlines. In fragile tops, silver collapses on any excuse. The tape tells you which it is. And here's a simple reality. Price can whip around violently even if the thesis is correct. You must be able to say, out loud, I can be right on the trend and still get hurt on the path. That sentence alone saves people, because it forces you to manage path risk. It keeps you from over-levering. It keeps you from making one-week volatility the judge of a multi-month thesis. Now, let's address the skepticism head-on, because your audience is not naive, and neither am I. There are real counterpoints. 1, silver is famous for mean reversion after blow-off moves. 2, high prices invite recycling, scrap flows, and producer hedging. 3, speculative mania can temporarily detach price from near-term demand. 4, if rates spike or the dollar strengthens abruptly, precious metals can get hit even if the long-term story is intact. Those are not reasons to be bearish. Those are reasons to stay disciplined, because the way you lose in silver is not by being wrong once. It's by being right and then giving it back through emotional decisions. And that's where the real pressure starts. So here's the psychology shield specifically for this week. Expect 3 types of emotional manipulation. First, the headline ambush, a central bank comment, a geopolitical flash, a policy rumor, something hits at an illiquid hour and price gaps. If you don't have a plan, you'll chase. Second, the wick of shame. Silver plunges intraday, prints a horrifying low, then recovers. The purpose of that wick is to transfer metal from weak hands to strong hands, not in a conspiratorial sense, just in a structural sense. Thin liquidity allows stops to cascade. Third, the victory lap trap. Well, after a huge move, everyone around you starts posting targets and certainties. That's when risk quietly rises, because complacency is the real top signal. Your defense is simple. You trade your rules, not your feelings. You pre-decide what constitutes confirmation, what constitutes invalidation, and what you do if the market violates your comfort. And you keep your position size small enough that you can follow the rules, because rules you can't follow are not rules. They're decor. Now, let's make this practical. with an if-then checklist you can actually use without staring at the screen all day. If silver stays above the prior breakout zone in the low hundreds and bounces with force, then the market is telling you the dip is being bought by real demand and risk managers are not forcing a full unwind. If silver loses that zone, can't reclaim it, and the selling has follow-through into the end of day, then you treat it as a regime shift in the short term. Maybe still bullish long term, but short term damaged. That's invalidation for the straight up from here idea. If silver presses the mid 110s and holds, then your upside roadmap remains intact. If it spikes into the $120 magnet area and then rejects hard with expanding volatility, you assume the market is trying to shake out late longs. You don't interpret it as betrayal. You interpret it as the cost of doing business in silver. But that's not the part that matters. The part that matters is how you implement this depending on what you own. If you own physical, your enemy is not the intraday candle. Your enemy is panic and the temptation to trade a long-term hedge. If you're holding physical because you distrust institutional promises, then don't turn around and let a 6% intraday swing convince you you made a life mistake. Physical is about durability and optionality, not perfect timing. If you own an ETF or an ETP for exposure, your enemy is liquidity-driven gaps and emotional overtrading. ETFs can be useful tools, but in stress regimes, they can move fast, and you need to respect that. If you own miners, your enemy is leverage on leverage. Miners can outperform in bull moves, but they also carry equity risk, operational risk, jurisdiction risk, and the market's tendency to punish them even when the metal holds up. So if your silver position is actually miners, be honest, you're not just long silver. You're long a bundle of risks that can decouple in ugly ways during volatility spikes. Manage accordingly. And now, the what comes next roadmap, because this is an action plan, not a sermon. Over the next week or two, you're watching for the market to answer 3 questions. 1, does the market accept above triple digits as the new normal, or does it treat it as a temporary overshoot? 2, does physical tightness persist in the form of premiums, borrow tension, and front-end urgency, or does it relax as supply responds and sentiment cools? 3, do risk managers and macro flows support the move into month end, or do they force a reduction that creates a deeper retest? You don't need certainty. You need response patterns. In a controlled pullback scenario, you look for stabilization, you respect the retest, and you avoid panic selling into the exact moment the market is trying to refill inventory. In a continuation squeeze scenario, you respect the trend, but you pre-accept that sudden air pockets are part of the ride, and you don't lever yourself into a margin-driven decision, because if this one level breaks, the math changes. Let's lock in the core levels one more time, clean and simple, and then we'll close. The first level zone is the low hundreds breakout area. Hold above it, and the bull structure remains intact for the week. Lose it and fail to reclaim it, and you downgrade the short-term setup. The second zone is the mid-110s battleground, where the market is deciding whether this repricing sticks. Acceptance here keeps pressure on shorts and keeps dip buyers confident. The third zone is the $120 magnet above, where volatility can explode in either direction, and where you must assume gap risk is real, not theoretical. Your invalidation is not, it went down. Your invalidation is, it broke structure and couldn't reclaim. Your confirmation is not, it went up. Your confirmation is, it held the right levels and the sell pressure couldn't follow through. That's how you stay logical in a tape designed to make you emotional. And here's the subtle CTA, because I'm not here to beg for attention. I'm here to build a certain type of investor with you. If you're the kind of person who wants mechanics over narratives, incentives over outrage, and a checklist over a prophecy, stick around and keep comparing notes with people who trade process first. This market will try to isolate you into panic. Don't let it. Stay mechanical, stay scenario-based, and let the market prove itself one way or the other this week.